Imagine a marketplace where fortunes are made and lost every second, where global economic trends play out in real time, and where each choice has the potential to build your financial future. Welcome to the stock market. It's dynamic, thrilling, and yes, it can be daunting. But understanding how it works can turn this vast financial arena into a powerful tool for achieving your financial goals. Today, we'll break down the essentials of stock market investing, from the basics of stock trading to the psychology behind market movements. Let's dive into the heartbeat of the financial world and uncover how you can harness its power. At its core, the stock market is a marketplace where buyers and sellers exchange shares of companies. When companies want to raise funds for expansion or innovation, they may offer a portion of their ownership to the public through an initial public offering, IPO. This transforms the company from a private entity to a public one, with shares that anyone can buy or sell. Once shares are publicly available, their price is determined by supply and demand. If more people want to buy than sell, the price rises. If more want to sell than buy, the price falls. This price movement is influenced by various factors: company performance, industry trends, and broader economic conditions. The stock market acts like a barometer for the economy, with rising markets, bull markets, signaling economic confidence, and falling markets, bear markets, hinting at potential downturns. Yet, the stock market is distinct from the economy itself, more of a reflection of corporate valuations influenced by global events, political stability, inflation, and interest rates. Investing in stocks carries both risk and reward. Generally, the higher the potential return, the greater the associated risk. Stocks can yield excellent returns, but they're also known for their volatility. To balance these risks, investors often diversify their portfolios across various asset classes, such as bonds and real estate, in addition to stocks. This approach of not putting all your eggs in one basket helps spread out risk, allowing some assets to buffer the losses of others. Investors also use various strategies to manage risk. Some perform fundamental analysis, which involves analyzing a company's financials to determine its intrinsic value. Others rely on technical analysis, which examines past stock price movements to predict future trends. There's also the strategy of trend following, where investors buy on positive news and sell on negative developments. Each method has its strengths and drawbacks, but successful investors often combine strategies to make informed decisions. There's more than one way to approach stock investing, and each method suits different investor goals, risk tolerances, and levels of engagement. Individual stocks. Buying individual stocks is like choosing specific books from a library. Each stock represents a small piece of a company, and if that company performs well, your stock's value can rise significantly. This method allows for high control over your portfolio, but it also means you bear the responsibility of researching each company's health and growth potential. Individual stock investing requires time, focus, and a tolerance for the ups and downs that come with single company performance. Mutual funds. Mutual funds pool money from many investors to purchase a broad mix of stocks, bonds, or other assets. This setup provides diversification, which can lower the risk of any single investment failing. Managed by professionals, mutual funds allow you to benefit from expert oversight while diversifying your holdings. However, they come with management fees, which can impact returns. For those seeking a more hands-off approach, mutual funds are a convenient option that balances risk and return. Exchange-traded funds, ETFs. ETFs are like a middle ground between individual stocks and mutual funds. They offer diversified portfolios but trade on stock exchanges like individual stocks, giving investors flexibility to buy or sell throughout the trading day. ETFs often track specific indexes, like the S&P 500, aiming to replicate the performance of those indexes. With lower fees than mutual funds and the liquidity of stocks, ETFs are a popular choice for investors seeking diversity and simplicity. Indicators are tools that help investors gauge the health of the economy and stock market. Just as a sailor uses a compass, investors rely on indicators to guide their decisions. Commonly used indicators include stock indexes, the S&P 500, Dow Jones Industrial Average and Nasdaq Composite, track the performance of various market segments. These indexes offer a snapshot of overall market trends, signaling optimism when they rise and caution when they fall. Interest rates, set by central banks. Interest rates impact borrowing costs and influence economic growth. Lower rates encourage spending and investment, while higher rates can cool an overheated economy. By watching interest rates, investors can make educated guesses about economic health and determine where to allocate their funds. Inflation. Inflation reflects the rate at which prices for goods and services increase. Moderate inflation is usually a sign of a growing economy, but high inflation erodes purchasing power. Monitoring inflation rates can help investors choose investments, like stocks or real estate, that tend to keep pace with or exceed inflation rates. Employment figures. Employment rates are an indicator of economic strength. High employment suggests consumer confidence and spending power, which is positive for many sectors, while rising unemployment may signal trouble ahead. The stock market is not just numbers and trends. It's also influenced by human emotions. The psychology behind investing plays a major role in why markets move and why bubbles form. Herd mentality. People naturally tend to follow the crowd, especially in high-stakes environments like the stock market. Herd mentality can drive stock prices away from their intrinsic value, leading to inflated bubbles or panic sell-offs. Fear and greed. These powerful emotions often dictate investor behavior. Greed can push investors to take high risks in pursuit of greater returns, while fear can trigger panic selling at the first sign of trouble. Both emotions can cause irrational decision-making, which can be detrimental to a portfolio. Overconfidence. Some investors overestimate their ability to predict market movements, leading to risky decisions. This overconfidence can result in costly mistakes, like holding on to losing stocks or ignoring the need for diversification. By understanding these psychological factors, investors can develop strategies to keep emotions in check. Setting clear goals, establishing buy-sell rules, and diversifying portfolios are all ways to counter emotional biases and stay disciplined. There are two main approaches to evaluating stocks: fundamental analysis and technical analysis. Fundamental analysis. This approach examines a company's financial health, market position, and growth prospects. Fundamental analysts believe that a stock's price will eventually reflect its true value based on earnings, revenue, and competitive advantage. This approach suits long-term investors who want to buy and hold stocks that are undervalued. Technical analysis. This method focuses on price patterns and trading volumes to predict future movements. Technical analysts look for trends and signals in historical price data, using charts and indicators to forecast short-term price changes. This approach is favored by investors who prefer quicker, tactical trades based on the momentum of stock prices. Many investors combine these two methods, using fundamental analysis to identify promising companies and technical analysis to determine the optimal timing for purchases or sales. The choice between long-term and short-term investing often reflects an investor's goals, risk tolerance, and time horizon. Long-term investing. This approach is about patience and compounding returns over time. Long-term investors look for strong companies with solid fundamentals and hold on to them, riding out market fluctuations. The power of compounding can significantly increase wealth, making this approach suitable for those who want steady growth. Short-term investing. Short-term investors focus on capitalizing on market volatility. They buy and sell stocks over short periods, often relying on technical analysis to time their trades. While this approach can lead to rapid gains, it requires constant attention and carries higher risks, as frequent trading can also erode profits. Some investors choose a blended approach, holding a core of long-term investments while occasionally making short-term trades to capitalize on market opportunities. This balance allows them to benefit from the stability of long-term growth while remaining agile enough to seize quick gains. The stock market is an intricate and powerful financial ecosystem, where understanding its nuances can be the key to unlocking wealth-building opportunities. By balancing risk and reward, diversifying across various asset classes, and staying mindful of both economic indicators and human psychology, investors can navigate this complex landscape with confidence. combining fundamental and technical analysis, helps form a well-rounded investment strategy, while the choice between long-term and short-term investing offers flexibility to match individual goals. As you continue your journey in the stock market, remember that knowledge, discipline, and patience are your strongest allies. Each step you take builds a foundation for financial growth, resilience, and success. Here's to navigating the stock market with purpose and turning financial goals into reality.